Hello everyone, my name is Kea. Today I'll be presenting our final project on corporate finance. Let me share the screen for that. Okay, so today in this presentation, I'll review the key concepts of corporate finance and how financial managers make important decisions that affect a company's success. So, corporate finance mainly focuses on three major financial decisions. The first is capital budgeting. This means deciding which long-term projects or investments the company should pursue. Financial managers analyze potential returns and risk before investing in assets such as equipment, buildings, or new. Second decision is capital structure. This involves determining how the company will finance its operations. Companies typically use a combination of debt and equity, and managers must find the right balance to avoid excessive financial risk. The third decision, called working capital management, this one focuses on the company's short-term financial activities, and these financial decisions are usually overseen by the chief financial officer. Understanding these three roles helps explain how financial decisions influence overall corporate performance. Next, we'll discuss about market value and the book value. See the difference between these two, which are very important ways to measure a company's asset. Book value is based on historical accounting record. It represents the original cost of assets minus depreciation and follows standard accounting rules. However, book value does not always reflect the true economic value of an asset. Market value, on the other hand, represents the price at which an asset could be bought or sold in the current market. This one reflects supply and demand, investor expectations, and economic conditions. Because of this, market value is usually more relevant for financial decision making since it reflects the actual value investors are willing to pay. For example, assets purchased many years ago may appear on the balance sheet at a very low book value, even though the real market value today could be much higher. Now we'll talk about the DuPont identity. The DuPont identity is a method used to analyze return on equity, or which we can call ROE. ROE measures how effectively a company generates profit from stakeholders, shareholders' investment. The DuPont formula breaks ROE into three components. First one is profit margin, which measures operating efficiency. It shows how well a company controls costs relative to sales. Second is total asset turnover, which measures how efficiently the company uses its assets to generate sales. Third one is the equity multiplier, which measures financial leverage and shows how much debt the company uses compared to equity. Here the formula is ROE equals profit margin multiplied by asset turnover multiplied by equity multiplier. By separating ROE into these three components, managers can identify if the performance changes are caused by cost control, asset management, or financial decisions. In this slide, we'll talk about the sustainable growth rate, or we can call it in short SGR. This one represents the maximum rate at which a company can grow without needing external financing or changing its capital structure. This growth depends mainly on two factors. First one is return on equity, which measures profitability. Second is retention ratio, which represents the portion of earnings that the company keeps instead of paying out of as dividend. The formula for sustainable growth is SGR equals ROE multiplied by the retention ratio divided by 1 minus ROE multiplied by the retention ratio. This concept is important because if a company grows faster than a sustainable rate, it may face financial problems. For example, in the case of Tata Toys Emporium, the company achieved a sustainable growth rate of about 17.40% based on its profitability and earnings retention. Now we'll talk about one of the most important principles in the finance. This is about the time value of money. This concept states that the money today is worth more than the same amount in the future because it can be invested to earn interest. There are two main calculations used in this concept. The first is future value, which shows how much money today will grow over time with interest. The second one is present value, which determines the current value of money that will be received in the future. The basic formula is future value equals present value multiplied by 1 plus and the interest rate raised to the number of time periods. Powerful example of this concept can be compounding. For instance, if I invest in dollar at 5.5% interest for 200 years, it will grow to over 447,000, showing how powerful compounding can be over long periods. Now we'll talk about annuities and perpetuities. We discussed which involve these annuities and perpetuities involve streams of regular payments. An annuity is a series of equal payments made of regular intervals for a fixed period of time. The examples could be loan payments, mortgage payments, retirement savings, deposits. The present value of an annuity helps determine the total value of these future payments today. A perpetuity, on the other hand, is a stream of payments that continues forever. A common example is preferred stock dividend. An example of annuity growth is retirement savings. Suppose if someone deposits $2,000 every year for 40 years at 7.5% interest, the total savings can grow to more than 454,000 due to compounding. Now we'll talk about the bond valuation. A bond is usually a loan made by investors to a company or government. Bond valuation involves calculating the present value of two components. First, the coupon payments, which are regular interest payments made to investors, which is now repaid when the bond matures. Bond prices are influenced by the relationship between coupon rate and yield to maturity. If the coupon rate equals the market yield, the bond sells at par value. If the coupon rate is lower than the yield, the bond sells at a discount. If the coupon rate is higher than the yield, then the bond sells at a premium. This shows the inverse relationship between interest rate and bond prices. In this slide, we'll talk about the dividend growth model, which is also called the Gordon growth model. This is used to estimate the value of a company's stock. This model assumes that the dividends will grow at a constant rate forever. There is a formula: if the stock price equals expected dividend divided by required return minus growth rate. This model is most useful for stable companies that regularly pay dividends. For example, if investors expect a $2 dividend and a $14 selling price next year, and the record return is 20%, the estimated current value of the stock would be $34. This model helps investors determine whether a stock is fairly priced or not. There are two important techniques used in capital budgeting. They are net present value or NPV and internal rate of return or IRR. NPV calculates the difference between the present value of future cash inflows and the initial investment. And if the NPV is positive, the project adds value and it should be accepted. Here is the discount rate that makes the NPV equal to 0. Managers often like the IRR because it expresses the return as a percentage. For example, a project requiring 165,000 investment generates positive cash flows and results in an NPV of $12,627 at a 12% required return, with an IRR of 16.7%. Since both indicators are favorable, the project should be accepted. Scenario analysis, another thing we'll examine here, which will help evaluate project risks. Scenario analysis examines how the project's NPV changes under different situations such as best case, worst case, and most likely scenario. This helps managers understand potential risk and uncertainties. These tools help managers better understand how changes in sales and cost can affect project profitability. At the end of my presentation, I have added my references below. Thank you so much.